Hi guys, welcome back. Today for technical analysis, reading the charts, we are moving on to chapter 2. What makes the markets move? For this chapter, we will cover supply and demand with apples, applying it to the markets, main factors affecting supply and demand, positive, negative, and unexpected, a note on the markets, and finally, a sum up of the lesson. So before we begin, I just want to show you how stocks typically move. What we have here is the chart of Facebook, and you can look at how Facebook moved over a period of 1 year. So you will notice that the movement of a stock is not in a linear pattern, meaning it does not move up in a straight line, nor does it come down in a straight line. Stocks typically follow a zigzag pattern. This means when a stock moves up, it would come back down for a while before continuing the move upwards. And you can see it happening over here as well. As Facebook moved up, it came back down for a while before continuing to move up again. The same happens when a stock is moving down. As it moves down, it will move up for a while before continuing its move downwards. Now stocks move in a zigzag pattern because investors are opening new positions or selling old positions. So to get a better idea of why this happens, let's look at our next example. Supply and demand is the basic factor that drives the market. So let me give you an example using apples on how supply and demand works. So imagine you are an apple seller and that you sell apples. So you find that the demand for your apples is about 10 apples a day. Now imagine if one day scientists were to release a research article saying that, eating apples will make people live longer. Then you find that the demand for your apple shoots all the way up to 100 apples a day. And here is an example of when demand is larger than supply. Because you can only provide 10 apples, but the demand for your apples is 100. So the price of each apple that you're selling will increase. But what if, however, scientists were to release a research article saying that, eating apples, they are harmful and that you shouldn't eat apples as it will cause you to lose your hair. Suddenly you find that the demand for your apples from 10 apples a day, it drops all the way to 0 apples a day. So here is an example of when supply is larger than demand. Because you can provide 10 apples a day, however you find that nobody wants to buy your apple and that the demand for it is 0. So the price of each apple that you are selling will drop. The concept of supply and demand is also applied to the markets. When there are more sellers than buyers, or when we say there are more bears than bulls, the stock prices will fall. And we call this a bearish market. When there are more buyers than sellers, or when there are more bulls than bears, the stock prices will rise. And we call this a bullish market. So now what are the factors that affect supply and demand? Well, there are actually many factors that can affect supply and demand. However, I'm just going to touch on 2 important factors. They are the outlook of the company and the outlook of the economy. So one easy way to remember this is a positive outlook will bring investors and the stock prices will rise, whereas a negative outlook will lose investors and stock prices will fall. Also, you need to know that the price of a stock will make a huge jump on unexpected news. So let's look at some examples to illustrate this. So the first example that we are going to look at will show you how positive news regarding a company will help raise the stock price. And for that, we are going to look at Apple and the iPhone 7. So when the iPhone 7 was released, it was quickly sold out in many places. And this was positive news for Apple as it showed that there was still a great demand for their phones. So investors picked up on this news and the stock price of Apple rose quickly after that. Now let's take a look at another example to see how unexpected positive news can help a company raise its stock price. And for that, we are going to look at Pokemon Go. Pokemon Go was a huge success in many countries and almost everyone had heard of it or was playing it. Now Pokemon Go's success exceeded the expectation of even the game developers themselves. So the stock of Nintendo rose sharply on this great piece of unexpected news as investors were very positive about Nintendo's future outlook. However, it turned out that Nintendo only owned a small portion of Pokemon Go, and the price of Nintendo tumbled down quickly afterwards. Now we are moving on to Twitter, where we will observe how a negative outlook for Twitter caused investors to leave the company. Now, Twitter is a stock whose price has been dropping because it has been facing huge competition from the other giants in social media, for example, Facebook, Snapchat, and Instagram. It has been struggling to keep its users and market shares as it has been unable to come up with any new or innovative features. This showed a very bleak outlook for Twitter, and investors they are not interested in a company that is unable to generate growth, and thus this leads to Twitter share price falling. So for the next example, we are going to move on to Wells Fargo. This is an example of a company that was affected by unexpected negative news. Wells Fargo was hit by a scandal where their employees were caught creating false bank accounts for their customers just to hit their sales target. So after this was revealed to the public, investors took note of this news and their stock price was sent falling down. So what you've just seen are just some examples of how positive news and negative news as well as unexpected news can affect the stock price of a company.
Subscribe for more content.